One Battery Park Plaza on the 9th floor. Some attendees are participating by Zoom. The time now is 9:47 a.m. And I'd like to ask the Executive Director to commence with the roll call, please.
Thank you, Madam Chair. Good morning to all. For Mayor Adams.
Bill Dukes for Mayor Adams.
For Controller Lander.
Allison Hirsch.
For Commissioner Nybach. Finance.
Human Rate.
For the UFA, Andrew Ansbro.
Bob Eustace with Andy Ansbro proxy.
Bro. I'm sorry, that's proxy. Mr. Eustace.
Eustace present.
Edward Brown.
Here.
Eric Bischoff.
Present.
Vita. John Young.
Peter DeVita's proxy.
Perfect. For the UFOA, Mr. Christopher Jensen.
Present.
Mr. William Guilfoyle.
Here.
Mr. Paul Mannix.
Here.
And for Fire Commissioner's Office,
Carol Brown,
we have a quorum.
thank you. And we will go into
Can you hear
the
me?
public agenda, and I will turn it over to Joan first.
Kim, I can't hear them so well.
Hello, all. Thank you, Commissioner. So we have a very quick public agenda. We have one item, a resolution was circulated to the board last night regarding our holdings in a foreign country. And if the board doesn't object, we'll just proceed with that in public, as we've done at other boards. So the resolution that's been provided before you is a resolution proposed by the Comptroller's Office that would request that the board take action to ultimately divest from Russian securities. We've asked that the investment consultant, as well as the appropriate folks at the law department, look at this resolution. And I believe the law department is on if there's questions which we'd need to address an attorney-client. There's also questions if there's questions specifically for BAM. Mike Haddad is here. I just want to note that for the record. The interim chief investment officer, and also Doug Mosley is here from NEPC. If there's specific questions about the holdings, if there are questions that would be better addressed in executive session, and we would revisit this at the end of the meeting in public, we're happy to do that as well. But I believe the resolution itself is fairly self-explanatory. I don't think it's lost on anyone in this room that the atrocities that are going. And
I'm sorry. I can't hear them.
But they reopened yesterday, but are limiting the amount of liquidity within the market, causing an economic concern to this fund and to long-term investors such as the pension fund. So with that, we have the resolution here. I'm happy to open up to questions if anyone has any additional comments. And if there's issues about the resolution that you'd like to take up in executive or an attorney-client session, we're happy to do that as well.
Can anyone hear me?
So,
Yes. I can hear you, Yafa.
The boardroom can't hear me so well, and but they're cutting in and I can't tell them.
okay, we got better.
That is better.
Also, John, please tell everybody to mute.
Can everyone please mute?
And just to, who has Peter DeVita's proxy? I couldn't hear who that was.
Bobby Eustace.
Okay.
John Young, Peter DeVita's proxy.
Okay.
So we've introduced a resolution. We're asking if the board would like to take action at this time, or if there are questions that they have for either the law department or for NEPC. And if there are none, we would introduce the resolution. So so we'll make the motion from the controller's office. Is there a second?
Second. Schumann Ray.
Extremely hard one to answer, and I would couch it in.
I'm sorry. Mike,
Yeah, is this better?
the question was off the record. So if Liam said anything, I couldn't hear him.
I apologize. My question was simply from a fiduciary standpoint. People are not going to stop doing business in Russia forever. And so I'm just curious if we are making any type of a financial mistake walking away at the bottom instead of, I know that there was talk of a possible 6 months to see what the markets do after they reopen, which I think they reopened this morning. And I just wanted to get that perspective.
So I'd answer in a few different ways. Impossible to answer. Depends upon how the war ends. You know the different scenarios. Bad ones, they're going to be isolated for a long time. As to the markets reopen, a few other comments. Russia's percent of GDP in the world economy peaked probably in the 80s when they were Soviet Union and larger, 16% of GDP. They're now down to 6-ish, 5-ish. And if they are isolated from the rest of the world for a long period of time, I think you can think about Russia being a petrol state for China, and that's it. And I think they get cut off from the world for a long time. Don't know whether these companies can survive. As an example, to your point, Sberbank, international European bank, is trading at $16 a share pre-invasion. It trades for a penny, 2 pennies now. I believe the resolution is crafted to divest in a prudent way, and that leaves some degrees of freedom to or don't exit when the market is open for foreigners to trade in. So today's opening, it was up 3% or something. Nonsense. No foreigners allowed to trade, or no short selling allowed to trade. The Russian central bank was intervening, buying their own stocks to try and create this image of that. Shortened hours, nonsense. Don't believe that that's a signal of anything to come. But I believe the resolution, and Doug, we've been in touch with this, to provide, with the word prudent, some degrees of freedom to do that. Do we need to sell the first day it's open? Necessarily? Thank you.
And Mike, just so you know, you're coming in and out. I got it, but you're kind of like fading in and out.
Sorry, Yafi's having trouble hearing. I think the rest of us who are on the phone or on Zoom are having trouble hearing as well. It almost sounds like there's something sweeping around where the sound is, and it's very difficult for her to hear and the rest of us as well. I don't know if there's something near the sound input or what the problem is, but it is very difficult.
You need to get closer to your mic. We can't hear you.
Funny. Okay. Sorry. I was just saying Yafi is having trouble hearing, as are the rest of us. There seems to be something sounding like it's almost sweeping near where the sound input is. So I don't know what the problem is, but it's very, very difficult for Yafi to hear as well as the rest of us. Thank you.
Bobby's mic is great, by the way.
I think what Bobby.
Thank you very much. I appreciate it.
We can hear everybody on Zoom. The people in the meeting have to speak close to their mic. The board meeting.
Okay, we'll try to work on the issues regarding.
If we could get a line item for 2 more, maybe 10 more inches on each microphone, that might help us in the communication and the budget. I don't know. I'm just asking. Maybe if we can make a request, we'll talk about it later. But maybe 10 more inches. I think this might really help a lot of things. Just saying. I don't know. Yeah, a bigger button too might help too. Maybe one on each side.
We'll note the budgetary constraints of the fund, and we'll take that up at a meeting coming soon.
Yeah, case in point, Doris, I can't hear you. Just pass Bobby's mic around to everybody when you want to talk. Apparently, it's the only solution we have.
It has to turn green, so like, it wasn't turning green a second ago. There it goes.
Now it's green. Okay, we will address budget concerns at a meeting of the regular board in the near future. Until then, we do have a resolution on the table that was made by the Controller's Office. Is there a second?
Second, Liam Guilfoyle.
If there are no comments, is that a chorus of ayes? Aye.
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 Okay, thank you. So with that, the motion to divest from Russian securities is passed. So with that, I'd like to make a motion to enter into executive session to discuss specific managers.
Don't wait, sorry.
Oh, you have the quote? Do you have it ready? Oh, I'm sorry. Before we do that, Mike Haddad has a quarterly presentation that he has prepared for the board that we're going to do in public. I just was so with that, I'm going to go to Mike.
Yafi, how is this?
I can hear you now.
Excellent. Okay. Good morning. We are pleased to report your Q4 performance reporting, and you will note some meaningful changes in how we've done this in the past. So we're happy to do this. It's customized to your portfolio. So one of the benefits of doing this individually is we get to talk about your portfolio only, and we don't have to do any comparative to others. So I think you're gonna like it, but appreciate feedback sometime afterwards. And we're going to break it into 4 different things. So I'm going to combine markets and portfolio returns at a higher level. Dan, our chief risk officer, is going to hop in and get some risk analytics around Q4. Then we're going to pivot into some forward-looking concerns in the marketplace, mainly the Fed and the Russian war. Dan has done some scenario analysis, and some stress tests on your portfolio around different outcomes. And then we're going to pivot into executive, and we're going to give you a much more recent performance data on your portfolio as of the close on Monday. And then we have 2 manager recommendations for your consideration in private equity and real estate. So with that, let me just jump right in. Next slide, please. Hopefully my slides are okay. So public market returns for the 4th quarter. So usual slide. These are the markets, the public markets only, and I would draw your attention to the 3-month column. And a couple takeaways from here. You'll see the U.S. equity market return was robust, both outright and relative to international and emerging markets. So remember that number because I'm going to refer to it a few more times. It has some implications for some other things in your portfolio. The other things I would note, long duration fixed income had a positive return for the quarter. And we'll get to that in a second. But the lower 2 rows on this slide, your credit portfolios had slightly positive returns as the short end of the bond market moved differently to the long end of the bond market. Next slide, please. So what were the key drivers of market returns in the 4th quarter? A few different things, and I'll go quickly because this feels like ancient history. The Omicron variant was rapid during the 4th quarter. It didn't really hit the U.S. until mid-December, but if you recall, it started in Johannesburg, as quickly was in the UK and Denmark. So it was well. The implications and the contagiousness was well forecasted by the scientists and the doctors. So it resulted in the service sector reopening being slowed, and that helped long maturity yields stay low globally. At the same time, though, inflation was increasing in the 4th quarter. And if you recall, the consensus was it was transitory and it wasn't going to stay. In hindsight, we know that was not correct. But what that resulted was Fed rate hikes started getting priced into the front end of the curve. The yield curve flat. This is what I was talking about in the previous slide. So short rates, 2-year notes were up 35 basis points, while 30-year bonds were down 15 basis points. To have those two securities move in the opposite direction is very unusual, and thus the results in the public market.
Read was that when that happens, it usually is a precursor to a recession, and it usually takes about 2 years. Just curious as to your thoughts on that.
Very topical debate in markets as we speak. Powell spoke Monday, addressed that exact question, and the way he answered it is more predictive is the 6-month, 18-month yield curve, which better captures expectations of the Fed. And when that curve inverts, meaning the market is forecasting Fed rate cuts versus hikes, that's a better indication of a recession. The long end of the bond market is influenced by many more global factors, including, European yields are much lower, Japanese yields are much lower. And then the other thing I would say is the cumulative impact of quantitative easing by the world's central banks, massive amount from the pandemic. That has influenced long yields as well. So I think that has more to do with it. Last point in Q4, emerging markets underperformance. So a few different reasons for that. The central banks in emerging markets started their rate hiking cycle earlier than developed markets. I've listed a few there. And then the other impact in emerging markets has been the Chinese equity market, which has been a big negative performer in the globe. And if you recall, they did this pivot to shared prosperity. And the first sector that took the hit was the private education sector. And then it spilled into some of the mega tech stocks and financial stocks. So the Chinese market is massively underperformed, and that added to the emerging market underperformance. Next slide, please. So here is your portfolio. This is both returns, NAVs, and returns by asset class of your portfolio. So I would draw your attention first to the darkened line, about 2/3 of the way down. You can see at the end of the calendar year, your total AUM was just shy of 20 billion. Your returns for the 3 months ending were 3.66. The 3 rows below that are 3 benchmarks that we'd like to look at your portfolio versus, and let me address each one of those. Start with the public market equivalent 65-35. So that's an index portfolio of global equities and U.S. fixed income. You underperform that by a meaningful amount. Why? It's the composition of the index versus the composition of your portfolio. Specifically, the index does not include emerging market equities. You do have exposure to them. So that's the main attribution for that difference in returns. Your custom policy benchmark is the second row, and you outperform that by 4 basis points. And that we're going to spend a lot more time on manager performance, both positive and negative throughout this morning. The last line is the medium tux. As a reminder, that is endowments, pensions, and foundations that are in similar size to yours. It's gross, not net. Why do you have underperformance in the 3 month and the 1 year? It's because their exposure to private markets is meaningfully higher than yours, and they have exposure to venture capital, which is at just a tremendous run. So going to your portfolio above that in the asset classes, what I would draw your attention to is the very positive 3-month and trailing 1 year returns in private markets. Real estate, private equity, and infrastructure all posted phenomenal returns on those 2 time frames, and that was strongly accretive to your portfolio.
What's the likelihood of us being able to get into venture?
Started the conversation with Anash.
I do know the reasons why they don't like to deal with public pensions. I'm just curious.
That's part of it. But more importantly, I would say is the funds are really small, and it's hard to allocate a meaningful amount of capital. If we stick to our 10%, 15% thresholds, but it's something we're investigating, we're looking into, and yeah.
But Mike, with venture, there's a process.
George, you're muted.
Can everyone hear me? Yeah, so I would build on what Mike said and say with venture, that it really is a numbers game for you guys. It's just going to be too hard to kind of get meaningful exposure. And I would also remind the technology sector has done so well right now. The venture funds look good. 4 or 5 years ago, institutional investors were talking about, will they ever do venture again? Because the cycle had gotten longer and the numbers were kind of trending a little below buyout and some of the other things you already do. And just to kind of build on the numbers on the screen, if you focus on the 1-year column, you're a little bit underweight private equity and real estate and infrastructure relative to your peers. You see the numbers in the 1-year column, all good. What are we kind of overweight a little bit relative to your peers? Fixed income, which is how we strike the balance in your portfolio. And you can see it was, a negative year generally for fixed income. So that's why you're in the third quartile instead of the, second or first quartile over the year. But your numbers have been good longer term, and your volatility has been balanced a little bit better. You've done better in down markets, which is something I think by design that we've tried to target in the last 4 or 5 years as you've adjusted your portfolio.
Now, how much does the Fed raising rates help in our fixed income?
Well, it hurts in the short term, right? And this is an economic argument. In the long term, if rates are back up on the 10-year at 3% or 3.5%, that's good generally for expected returns going forward. You just got to go through a little bit of pain cycle right now, and the pain is also volatile, right? The markets can overreact and settle back down. They can, anything right now between inflation, Fed, and other central banks changing their tune, and the war is going to create a lot of movement, I think. I mean, we've seen it. So, I think be prepared for more of that this year. Even if things go well in Russia and Ukraine or change or improve, we still got a lot of other things to worry about, right? Higher rates, higher energy prices are going to hit earnings. And that's just that'll, earnings season starts in, 2 weeks.
A couple of the comments to add. Doug referenced your underweight private markets relative to your peers. That's not a function of the asset allocation it's a function of what we ended up with, and that's a function of the basket class. I know your next question. We are on it. We're working on it. We're trying hard. We're throwing a lot of time and energy at it.
So we are still trying to get the basket clause into the state budget. I would say today, we have like a 50-50 shot of getting the state budget, but have a better, I feel more optimistic about getting it done this session. We had a good meeting with the State Department of Budget, who asked a bunch of questions, and with the Assembly Central staff this week. Senate is on board. So we're moving it. It's just a question about whether it can get into the final budget or not.
So Liam, I cannot hear you at all. I think he's talking, but I cannot hear him.
He didn't want that.
I want you to hear me.
Okay.
Next slide, please. So now we decompose your portfolio's excess returns. And recall, it was all of 4 basis points. We break that into 2 different asset allocation effect, manager selection effect. And you can see asset allocation effect was 0. Manager selection was 4 basis points in aggregate, but there's a lot of noise in that. And we're going to spend some time on that as well. I completely forgot in my intro. Apologies. The other change in how we're doing this is we're going to do deep dives in 2 asset classes per quarter with you. So instead of hearing, the 40,000 foot stuff from the CIO, we are going to have a deep dive today. We're doing public equities and infrastructure, and we'll rotate each quarter those asset classes. So today you're going to hear from John Mersberg on your portfolio in public equities, and Petra Nikolova on your infrastructure portfolio. Apologies for that. Next slide, please. So here is excess returns or alpha in your public market portfolio. The deviations most are in the world XUA and XUS and emerging markets. You are going to hear detail from John on that, so I'm going to skip that. And then the rest of it you can see is there's not a lot of excess performance, positive or negative. So I'm just going to pass over that in the interest of time. Because next slide, please. This is much more interesting. So we'll start with hedge funds. And we're showing this on 1 year returns. As a reminder, most of your private markets are marked with a lag. So a lot of this is as of end of September, and that's just the way that they work. So hedge funds had a slightly negative performance in the 3 month. I'm sorry, the 1 year and the 3 year. And that's, as you've heard from Neil over the years, your portfolio is in 4 different strategies. The 2 strategies that hurt the portfolio in this quarter were discretionary global macro and event driven. And the specific funds that in discretionary, all of them slightly underperformed, slightly had negative returns, and it really wasn't a good macro quarter. It was a tough environment for macro trading. I expect to have different in the first quarter because there were some ripe opportunities. The positive performers were in your portfolio were D.E. Shaw and a couple of your alternative asset trend following systems. So think Flooring Court and Gresham. They did very well. Moving down a row, private equity, you see spectacular excess returns on top of their spectacular absolute returns. So a few different comments here. The returns were driven both by realizations in your portfolio, and that means they've sold it and the profits are locked in, but also by markups of the existing portfolio companies. So, we hope those marks hold themselves, but, just perform. A few different little tidbits that I think are interesting. So the benchmark was the Russell 3000, which is a 31% return. 73% of your funds outperformed that. The star performers were all in excess of 70%, 70 on a 1 year basis, were Apex, KKR, EQT, and Warburg Pincus. I'm sorry, Warburg Pincus and Platinum were in excess of 50%. It was just those 3 in excess of 70%. Last tidbit, if you go to the 10-year number, you'll see underperformance versus your benchmark, and that's a function of your runoff portfolio. The 10-year return in your primary managers was in the 19%, your runoff 11%. So that is still negatively impacting your portfolio on a longer term basis.
That leads my question on where we're at with the secondary sale. Is it still a prudent move at this time?
We're on that as well. I have a meeting with Anash this afternoon to talk about that. The contract with the advisor that we had previously expired, so we had to go to our much discussed contracting process. So we're in the process of hiring a new advisor. It's in motion. It's happening. Consultants are on board. It's a priority view of this board, and again, we're on it.
And then in infrastructure, I noticed that we were at 1.3% of allocation when we have a 3% allocation in total. I'm just curious as to the reason why we're at 1.3 and what we're doing to get up to 3.
I'm going to allow Petra to answer that during her presentation today. Real estate, you see very strong relative performance here too versus your benchmarks. And that has to do a lot with the composition of your portfolio, meaning as you've kind of tilted more towards the favorable sectors that have worked out well during the pandemic. I'll just my notes here. In your core portfolio, it was more Exeter and Lion, which helped you in the non-core portfolio, again, Exeter, their industrial value fund had spectacular returns, and you got 25% plus returns from some of your big managers. Think Blackstone, KKR, and even the Green Book Asia Fund did extraordinarily well during this period. Last row on this chart is opportunistic fixed income. And again, you see strong excess returns here. And that really came from 4 different managers who accounted for 50% of that return. And these were managers that had more flexible mandates that allowed them to do some interesting transactions during the stresses of the pandemic. And those managers include Marathon, Apollo, Oak Hill, and KKR. Next slide, please. So we'd like to share with you as well the rebalancing activity that we've done on behalf of your portfolio, and then what asset classes are underweight or overweight. So in summary, there was a little bit of rebalancing activity out of the U.S. equity market, which you see in the left-hand side of this. That's the from side. That's what we sold. And we sold as the U.S. equity market. Remember, it had that very strong Q4 return. And the portfolio, because of the strong returns in the equity market, had gotten slightly overweight equities. And we just allowed those profits to continue to run rather than rebalancing them more actively, if you will. So it was a slight overweight for the past several as the equity markets were recovering. However, in the fourth quarter, as the inflation numbers were rising, we thought it was not advised to be overweight equities anymore. So we started taking profits out of the U.S. equity market as it continued to run. Recognizing the momentum in the market and the strength, we did it very slowly in 9 separate small transactions. Importantly, where did those proceeds go? That's the right side of the slide. They went both to the cash desk and to some of your underweight U.S. Treasury sleeves. Next slide, please. So rather than the bubble charts, we're trying this slide to show you the slight overweights and underweights in your portfolio, and importantly, the time series and how they evolved over the past few quarters. And if you go to the bottom part of this slide, you'll see the 3 sleeves of the equity market sum to around, in June, 1.3%, in September, 1.6%, and then in Q4, that number came down by 0.8. And that was a function of these 9 small transactions to reduce your U.S. equity overweight. What went up as we did that? Again, I alluded to the cash part of your portfolio went up a little bit, and the fixed income underweight stayed about the same. And why we recognize and 100% agree that in a long-term portfolio, the cash allocation should be 0. In a time of rising interest rates, when both fixed income and equities are potentially going to have negative returns, we feel it on a short-term basis. It's okay to put a little more money into cash during that time period. But again, I'm going to emphasize: look how small that number is. It's not even 1%. This finishes my part of Q4. I'll turn it over to Dan unless there's any additional questions, comments, or concerns on Q4. Over to you, Dan.
Thanks, Mike. Good morning, everyone. How are you? I have 2 slides. This particular section, just sharing some highlights from the risk summary that appears on your quarterly reports. If we'll jump right in, looking at the top left panel there, you'll note that total planned risk for the quarter ended in December was 10.41%. It's down from 11.23% in September. The benchmark risk is 10.54% in December, which was declined from 11.1% in September. The portfolio risk declined a little bit more than the benchmark risk, and we see small corresponding reductions in active risk and beta.
Dan?
Yep.
We're having trouble hearing you. Can you maybe get a little bit closer to the mic?
Sure. How's this? Hear me okay now?
Yeah, moderately better. Speak louder.
You got it. Sorry. So I was just mentioning that you see small corresponding reductions in active risk and beta quarter over quarter, comparing this quarter's highlights to last quarter's. If we look at the bottom panel, we plotted the ex-ante portfolio risk, the benchmark risk, and the beta for each of the last 12 months ending in December. You notice here that the projected portfolio and benchmark risk continued the downward trends that we observed in the quarters past, and that the portfolio beta has been relatively stable, ranging between 0.95 and 1.01 over the past year. The chart at the top right breaks down the change in risk during the fourth quarter into three broad categories. The top two lines, the change in volatility and the change in correlations, are market related or market driven phenomenon, meaning that these risks declined in step with market risks and were not a result of specific position weights or tilts in the portfolio. The change in portfolio exposures, that third line there, represents the portion of the portfolio risk that was detached from market trends. Here, the 40 basis point reduction in risk was led by U.S. spread and market factors. Finally, the table at the top center shows you the differences between your portfolio allocation by assets and your allocation to risk. As in quarters past, you'll note that we've allocated about 2/3 of the assets to equities, but about 95% of the overall risk is coming from those equities. We can elaborate that theme a little bit on the next slide. Here, we summarize portfolio allocations, performance, and risk by strategy as of December 31st. Looking at the leftmost section, you see a snapshot of your parking place adjusted allocations on December 31st. At that time, we had slight overweights to cash and underweight to core fixed income strategies. Again, alluding to what Mike mentioned on the slides past. The performance section in the center shows you the 1 year return by strategy relative to their benchmarks. Important to note here that the alternative asset classes are shown using their 1 year dollar weighted returns, and that private equity and private real estate and infrastructure are lagged by a quarter to better reflect the GP valuations. Here we see the alternatives outperforming their benchmarks, and we show an underperform in developed market equities that Mike mentioned before. And again, John Merseburg will elaborate on that in a few minutes. Next, we decompose the risk strategy in the rightmost section. The first three columns in that section show you the portfolio risk, the benchmark risk, and the active risk or tracking error for each strategy. Tracking error, just by way of reminder, it's an indication of how closely a portfolio follows the index to which it's benchmarked. For context, you can expect almost no tracking error coming from a pure passive portfolio, so that's benchmarked to a particular index. And you'd see perhaps 1 or 2% of tracking error coming from an enhanced index fund. And you'd expect to see something, above 4% for actively managed funds. Along those lines, you'll note that the tracking error is comparatively low for U.S. equities, where we're mostly in passive strategies, and a little bit higher for emerging markets, where we're invested with more active managers. And then lastly, we show you how the individual strategies contribute to overall portfolio risk in the rightmost column. That covers the section for today. Happy to take any questions you may have now.
Can you hear me? This is Doug from NEPC. I just wondered, looking at the numbers you just went through, are you seeing the model's correlation numbers for fixed income changing year to date, say through February, or any stats you have for this month? Is that something because of rates moving and equities going down at the same time, those numbers are changing dramatically or slightly?
I don't have that information right in front of me. The risk changing from end of year to current for fixed income, I'd have to look that up and get back to you, unfortunately.
Okay, thanks.
Okay, well, why don't I turn the conversation back to Mike and kind of go through more recent trends in the portfolio.
Yep. Doug, intuitively, we know negative returns in both fixed income and equities in 2022, function of the rate hikes. And when we had the thesis of the long duration was a negative correlation of returns in times of stress. And certainly this is a time of stress is what's going on in Ukraine. But because that event is inflationary, it's leaving the correlation of returns positive. So, I don't have exact stats in me, but intuitively, you can see it and feel it. And then the other reminder, and I forgot this, I was lost in some other thought. In the fixed income portfolio, you asked about the impact of the Fed. An action that you took at a joint recommendation from us and NAPC was to shorten the duration of your bond portfolio. That has served you well. So that it's limited, reduced the amount of losses in your portfolio because of the actions you all took.
I'm not mistaken, the basket hurt us there as well because we could only go so far with getting out of the long. And correct, did we get out of longs as much as we could down to 3% maybe?
Yes, but we put it in shorter maturities, and the riskiness of them is less. So the dollar value of a basis point's a lot less. So we're losing less than we would have otherwise.
Thank you.
Okay, forward-looking concerns. Next slide, please. I really want to spend some time on the Fed and the global rate hike cycle, and then a little bit of time on the Russian invasion of Ukraine. Next slide, please. So I think this is a very cool slide. So when you think about a rate hike cycle, what are the key determinants on how it's going to move markets? And that is the start date of a cycle, the pace at which they tighten, and the eventual point that the Fed needs to get to. So to help frame that, what this table shows on here is the starting point of two key economic variables for the Fed, and which is what their mandate is. On the horizontal scale, it's the unemployment, where they are versus target, and on the vertical scale, it's where they are versus their inflation target. And what this dot shows you is how different this cycle is from previous tightening cycles. And again, so vertically, it means they're far away from their inflation target. Horizontally, it's where they are versus their employment target. And this variable uses the unemployment rate. But what we've heard from the Fed is that the unemployment rate is not as fulsome an indicator as it has been in the past because of the decrease in the labor force participation. Said differently, the number of job openings by the JOLT statistics is something in the vicinity of 10 million jobs. So if you adjusted that dot would be more in the upper right quadrant. And it just illustrates how far behind the Fed is to its employment and inflation mandate. And it said differently how much tightening they need to do. Next slide, please. Speaking of how much tightening they need to do, this graph shows the number of 25 basis points on a 1 year forward basis priced in, looking back over the last year. So what are the takeaways from here? You can see the acceleration over the past few weeks as the market's gone to price in even more tightening. So on a 1 year basis, I think this chart's a couple days old. There's about 7.5 rate hikes priced in. And what's also changed is the May and June meetings now have May is priced for 41 of 50 basis points. So it's almost priced for 50 basis point hike. And the June meeting is priced for 39 basis points. So the market's starting to lean towards the next two rate hikes being 50 basis points. Next slide, please. This is the other key determinant. How far does the funds rate have to go? Again, this is market implied based upon some assumptions in interest rates. And you can see this number went up quickly over the past few days. And this had to do both with the Fed meeting last week, as well as importantly, Powell's speech on Monday. So the market's now priced for a peak funds rate of 240. And to frame that, when the Fed's in a rate hiking cycle, the questions that they're answering is, do we have to get rates back to neutral or restrictive? What does that mean? Neutral means a place where monetary policy doesn't influence inflation higher or lower, or growth higher or lower. It's more neutral. Restrictive means they need to slow the economy. They need to slow the economy to get demand for goods down, which will get inflation down. They don't say it in plain English, but the big question is, and to your yield curve question, are they going to stick us in a recession? They don't want to, but with inflation this high, you've got to get the funds rate over the inflation to slow down. So inflation's now at 8%. We all think it's going to come down. It hasn't peaked yet. We don't know how far it's coming down, and we don't know how quick it's coming down. Maybe.
So this is because I am not in finance. Are you saying they have to get the rate up above 8% in order to stop that?
No, because I concur with the consensus that inflation is going to come down as some of these supply chain things gets worked out, and as the economy reopens. Think of your own consumption basket in your own life. It's more goods than services because services have been shut down. We haven't traveled, we haven't taken vacations, we don't get on a plane. We're starting to, but as that happens in your consumption, you're going to stop spending on goods and start spending on services. So that's going to switch, as well as some of the supply chain things getting worked out. But when you think about the supply chains, and I'll get to this in the Ukraine, there's a lot of stuff going offline because of that. And importantly, last week, China, with its one COVID policy, shut down Shanghai and Shenzhen for a week. And Shenzhen is their manufacturing hub, and that adds to the supply chain difficulties. So while they will work themselves out, when and at what pace is the question. I think the consensus thinks inflation is going to get down to around 3%, so a funds rate in excess of 3%.
This is Eddie Brown. My question is, they're saying that in Germany, they're going to spend 6,000 euros more a year on fuel costs. And do you think that it doesn't look like anytime soon the price of gasoline is going to go down. So that's going to be part of inflation. I mean, they're talking about sending out checks to people and dropping the taxes. That's going to be a huge part for a long time to come, no?
That adds to the inflationary pressures.
Right. So my question is, we don't think that's going to come down anytime soon. If we're going to think inflation's going to come down.
I think that's reasonable. And an important distinction between Europe and the US on fuel costs and energy costs. We in this country have natural gas in abundance. Natural gas here trades $4 to $5 per BTU per million. In Europe, depending on the country, that price is 4 to 8 times higher, which then inputs into their cost of electricity being 4 to 8 times higher than it is here. A much bigger impact on Europe than here, and that has a lot to do with Europe's dependency on Russia for energy.
And also, Angela Merkel got rid of the nuke power too soon.
Yeah, noted.
We'll note your opinion on the on nuclear, Mr. Brown.
That's not just my opinion. You wait till next year in Germany and see what happens. When people can't pay, they're going to have to choose between their drugs and their heat.
Next slide, please. So it's not just rate hikes that the Fed and other central banks are going to be enacting in order to slow the economy. It's also quantitative tightening. So what this slide shows, the dark line on top of all these bars is the sum of quantitative easing amongst the world's central banks. And you notice the peak, the massive spike higher during the depths of the pandemic. That was during maximum quantitative easing times. Now that number has come down, but make no mistake that there's still quantitative easing in net effect going on. But the Fed has stopped. We expect to hear from the Fed at the May meeting that they're going to start doing quantitative tightening. What does that mean? That means the bonds that they own when they mature and they get the coupon payments, they're going to stop reinvesting those in the marketplace. All things being equal, that's less demand, should result in higher interest rates. So the two-pronged approach to slowing the economy, policy, rate hikes and quantitative tightening. Next slide, please. So how does this impact the equity market? Importantly, as a reminder, global equities are 47% of your portfolio. U.S. is, I think, maybe 29%. So this is the biggest allocation in your portfolio and something worth spending time on. The line graph here is the 1-year forward price earnings multiple, and one of the standards equity valuations one looks at. And so the key takeaways here, you can see most recently that the PE ratio has come down. That makes the equity market less expensive on this valuation metric. But if you look where that is relative to how far back is this graph going? Back to 97, the only time it was higher was during the NASDAQ bubble. So that's not necessarily a source of comfort, but nonetheless, that has come down. And when you think about PE ratios, a lot of it has to do it's a psychological measure of the market. A lot of it has to do with interest rates. And as a reminder, during the NASDAQ bubble, the 10-year note was more in the vicinity of 6 or 7% versus, 230 now. So we should have a higher PE ratio. Next slide, please. This is another source of concern. What this graph shows in the light colored line is the again the forward S&P multiple. The left hand scale shows the metric on that, and the blue line, the dotted blue line, is the 10-year note real yield as designated by the TIPS market, and the relationship here is as the real yield becomes more negative, PE multiples expand. Rather logical because the discount rate used when it's lower, the NPV, the net present value of those cash flows, is worth more. However, it works in the opposite way when it's going up. And what most market participants think is the real 10-year note yield's got to get somewhere between 0 and 1%, so further down that line, and that implies an equity multiple, somewhere of 14 to 18 times, which means more, tough sledding for the equity market. Next slide, please. All right, so now some slides of comfort on the equity market. With this line, this aggregates the PE, the forward price earnings ratio of the S&P 500 into the top 25 stocks, which is the light colored line, versus the rest of the market, which is the blue line. So while the aggregate market is being held up by a handful of stocks, the rest of the S&P is priced at a more reasonable level. And as a reminder that the top market cap stocks in the equity market are in order: Apple, Microsoft, the two Google stocks, Amazon, and believe it or not Tesla. So those companies still trade at elevated multiples, while the rest of the market is much more reasonably priced. Next slide, please. This is another source of comfort, if you will, in the equity market. A lot on this graph, so I'll try and explain it relatively quickly. It divides the equity market into different subcomponents: the S&P, large cap Russell, small cap Russell, Russell growth, large cap Nasdaq, and so on. The blue line shows the drawdown from peak of the index. The yellow bar shows the median stock, and the red shows the average stock. So the takeaway here is the indices have outperformed its components, and that's again because of the high cap weight stocks. But the carnage inside, underneath the market, has been meaningful. And I take your attention to the far right. If you look at the Nasdaq, while the index is down about 20% from its peak, the median and average stock is down more like 40-45%. So a lot of that fluff has come out of there already. So that this is a source of comfort in the equity market. Next slide, please. This is another source of comfort. A lot of the speculative excess has been wrung out of the market. So what this shows is a handful of the speculative parts of the market. What this slide shows is the IPO index, SPAC index, the renewable and clean tech index, and the fintech index. And these things are all down 40 to 60% from the peaks. So a lot of that froth has come out. The one not on here that I would mention is the crypto. The aggregate value of the crypto market's gone from an excess of 3 trillion to under 2 trillion. So that's down 40% as well.
Is the forward look at earnings being crushed by higher energy prices and a few other indicators? Is that priced into the market?
Yeah, I think some of that is this, and I think my 2 cents, and I'm interested in Doug's, is it's more has to do with the Fed and other central banks raising rates. So it takes liquidity out, slows the economy. The cost of interest is more important than the cost of energy. The energy intensity of our economy, so how much energy it takes to drive GDP, has really gone down over time as we just become more efficient and we use more renewables. So that impact is less. And importantly, the U.S. is net zero in energy. We're not a big importer anymore. So sectors of our economy benefit from higher energy prices, for the obvious ones. While if you're a net importer, it's just nothing but bad news for the economy. So we're a little bit better off than other countries, given that we're either import or export energy. Thank you.
few sectors or few factors. Wage inflation, I think, is something we get data points on, but they are lagging data points, and I think not reflected in earnings yet or earnings outlook. And again, earnings season starts in April, and that's when you're going to get, I believe, some surprises because of, I think the market's good at predicting companies, the bigger companies' sensitivity to energy prices and maybe some other commodity price factors like a Procter & Gamble. You can look at their cost structure and say, okay, we know, they're under pressure, but they can also raise prices. But on the technology companies, financial services, the wage inflation, I think, is something that's, you're going to hear more about that going forward because it's really getting competitive.
Thanks.
Next slide, please. So we've touched on this, and I'll bring up a few other points on Russia's invasion. So, geopolitical standpoint, this is a big deal. We live in the middle of it, and you kind of, we see it every night on the news. But this is a big freaking deal. First time in 80 years we've had open warfare in the European continent. So this is a tectonic shift in geopolitics. President's over there today meeting with the EU. He's going to Poland. It's a big deal. The other thing I would say is war historically has been slowing of growth and rise of inflation, to the word you whispered a second ago. And the president made this comment a couple of weeks ago. Defending democracy is going to cost. This is inflationary without a doubt. So drilling down into some of the market impacts, what are some of the obvious ones? This accelerates the world's pivot away from a deflationary environment to an inflationary environment. So this is additive to that, and that entire interest rates, all things being equal. Importantly, it's EU is going to have to change their dependency on Russian energy, and at the same time accelerate their transition to renewables. And it's not just energy. Russia and Ukraine are a big supplier of a handful of different commodities. I've listed wheat on here. Fertilizer, is a key component in the cost of farming. So that flows through as well. Eddie, you had asked about some changes in Germany. Another big change they did is they pledged to increase their spending on defense to 2% of GDP. So that's going to shift Germany into from a federal surplus to a deficit. And all things being equal, that's a higher impulse on interest rates going forward. And one of the reasons why
I think that the whole of Europe is understanding now that they're going to have to start defending themselves because we all see what's happening in Ukraine. And we know that if Germany decides to move into Taiwan, all bets are off. All bets are off. And right now, NATO don't look like it's looking to defend anybody.
I might disagree on that one, but we can do that one offline. And then, as far as the Russian economy, this is a quote from the Deputy National Security Council. I don't know if you caught it on 60 Minutes Sunday. It's worthwhile. But the Russian economy faces an economic abyss. They're cut off from the world. They're cut off from most of the world. The equity market is a disaster. Probability of default in the bond market is high, and their currency is depreciated by about 30% just since the invasion. And then lastly, this inflationary impulse from this is going to lead global central banks to increasing rates sooner, faster, and more, and that increases the chance of a hard landing. So this is not good for markets, not good for the world, not good for your portfolio. Let me turn it over to Dan, who has a very interesting scenario analysis regarding the war.
Great, thanks, Mike. And I guess before I jump in, Doug, just to follow up, my apologies. I'm so used to putting numbers to concepts that I almost don't want to speak, to one without the other. Though, that said, I think directionally you're right. But we'll run a report, and marry the two together, and I'll get you kind of a more fulsome explanation a little bit later this afternoon. Moving on to these scenario analyses, we're examining some MSCI research that attempts to frame the market's reaction function to the Russian invasion of Ukraine. The slide that we're looking at now shows you a summary of the two stress scenarios that were developed by MSCI's research. On the left side, you see there's a soft landing scenario where the conflict de-escalates before the market really prices in some structural changes. In this more optimistic scenario, a ceasefire and de-escalation of the conflict would stabilize energy prices around their current levels, thinking around at $100 a barrel. And apart from a small short-term impact, there are no persistent inflationary pressures. The hit to economic growth is small, and central banks would stick to their plans of tightening monetary policy. U.S. and German sovereign yield curves would flatten slightly due to slower growth. Global equities would decline somewhat, and then credit spreads would widen, and the U.S. dollar would strengthen relative to the euro. And there's the scenario on the right, the prolonged conflict scenario. In this dimmer analysis, we see a prolonged conflict that has longer-reaching market impacts. The idea is that the sanctions would impose significant drag on growth and inflation. You can see more extreme inflationary shocks here. Nominal long-term rates go up as long-term inflation expectation rise, and then the real long-term rates would drop a bit as the economy slow down. Higher energy prices and lower business and consumer confidence would slow economic growth. And then you see equity selling off more extremely, credit spreads rising, and then a more significant U.S. dollar gain relative to the euro. Given these assumptions, we have some results on the next slide. Great, thanks. Here we're showing the predicted returns for each of the scenarios for both the overall portfolio and then for certain strategies within the portfolio. Each scenario is represented by a different colored bar, and the resulting predicted change in value is, of course, plotted along that horizontal axis there. At the total portfolio level, you can see that the results range from about a 5% decline under the de-escalation scenario to a little bit more than 13% under the prolonged conflict scenario. You can see that international markets sell off more extremely than the U.S. as they're expected to feel the impact of the sanctions more deeply than our markets would. And finally, you can see that our defensive strategies like TIPS and structured fixed income, and even to some extent the hedge funds, are mitigating losses. I'll leave you there, but of course, happy to address any questions you may have now. Okay. Why don't we turn it back over to you, Mike, and we can kind of introduce John for his deep dive.
With that said, I believe that concludes the portion that we have for public session, and I'd like to make a motion to exit public session and enter executive session.
Second. Liam Guilfoyle, if that makes it easier.
So I would ask that any members of the public, if you could sign off and maybe.
During the executive session, the board discussed various investment matters, and now we need a motion to adjourn this meeting.
So moved.